As good investors, we should always be trying to add the highest quality companies to our investment portfolios. Now, these companies are extremely rare and few and far between. Right now in the United States, there are about 4,300 publicly traded companies. Out of those companies, out of those stocks, there's probably only a handful of what's been commonly known as compounding machines. These companies, which are the highest quality in the world, have very specific characteristics that we really need to pay attention to. And what I want to do today was go over my personal investment philosophy, what I've been able to achieve over the last 6 years with my own portfolio, reveal what I've been doing over the past 6 years, where it's gotten me, as well as how I identified these companies 5-6 years ago to add to my portfolio and what I'm going to continue to do for the next 6 years. Now, these companies are ones that we already know, right? Look at Apple. Look at the stock chart. Beautiful, compounding, consistent growth over time, up and to the right. Microsoft, up and to the right. It has probably the best fundamentals out of any company in the world. Microsoft's credit rating is better than the US government's. That should say something. The US government has a worse credit rating than Microsoft. Microsoft is an amazing compounding machine, and it has returned shareholders amazing amounts of wealth over the past 2 or 3 decades. NVIDIA, I mean, this is the AI darling of the past few years, up and to the right. There is something about this company that sets it apart from the rest. But it's not just big tech. We can go into MasterCard. MasterCard, up and to the right. Consistent, predictable growth. Netflix, up and to the right. Everyone knows Netflix. Netflix has had an amazing run over the past 2 decades. It started as this little, I'm going to rent a CD, and then they moved onto the internet, and look at how well that they've grown. There's something that sets all of these companies apart that we really need to dig into to understand how to be good investors and how to have consistently good returns in our portfolios. Here's my little disclaimer. I'm not a registered investment advisor. This is not investment advice. You can read the disclaimer if you want, but I'm moving on. So this is what I'm going to go over today. I don't want to waste your time. I'm going to go over my portfolio performance so far over the last 6 years, the characteristics of a strong portfolio, how to identify companies built for sustainable growth, when to hold, sell, buy, and ignore the noise, and most importantly, the mindset that keeps investors focused on their long-term successes rather than short-term dips and everything that can go on day to day in the stock market. Overall, I want to just cover a more disciplined, thoughtful approach to investing rather than what normal people will go to on TikTok and buy this and use margin and leverage or whatever, buy what's that ticker? ASTS, the space company, all these speculations and gambling. We don't want to gamble when we're putting our money on the line. When we're putting our life savings in our portfolio, we want to make sure that our risks are hedged and that we've done our homework and ensure that our money is right where we want it to be so that in 10 years time, we don't look back at our portfolio and realize, dang, I just lost all my money because I gambled it away on some random company that my friend told me to buy into. We want to be able to know how to identify these companies, to buy into them, have a long-term vision, and allow these compounding machines to grow our portfolio over time. So here's a look at my portfolio. You can see on the bottom here, I started in January of 2019. On the right-hand side is January 31st of 2025. So you can see where I've ended off after about 6 years. My compound annual growth rate from January 1st, 2019 to January 31st, 2025 is 30.7%. Pretty good by most people's standards. So take what you will from that. Now, I'm not including specific numbers for how big my portfolio is currently. I'm a private person. I don't like detailing stuff like that. But I will say that I do want to be honest. I don't want to say that, 90% of my portfolio is gains. Only around 44% is actually money that I put in. And then 56% of that is money that is from gains, capital appreciation, dividends, etc. That's resulted from the investment choices and decisions that I made. Below is a table. You can see what I currently have in my portfolio. Most people are probably going to raise their eyes as soon as they look at the first row. Yes, NVIDIA is about 50% of my portfolio currently. I'll talk about that a little bit later, but no, that is not a fluke. Yes, it is intentional. CrowdStrike is number 2 at 16.5%. I actually have an ETF as my third largest holding, which is the Vanguard Information Technology Index, or VGT, at around 15-16%. Microsoft, around 7%. Apple used to be a lot higher, but I've trimmed that down to 4.4%. MasterCard, 2%. Google, 1.5%. AMD, 1.3%. Meta, 1.2%. And Visa, 0.7%. You can use this to sort of judge the type of investor that I am. Clearly, I'm very big on technology. I'm also very big on AI, semiconductors, as well as the Magnificent Seven minus Tesla, pretty much. What sets my portfolio of companies apart is they're all winners. They're all winners. When you look at these companies, they are best in class at what they do. NVIDIA, #1 winner in the AI space overall. They've got the software to back it up. They've got the hardware to back it up. They have every single thing that NVIDIA touches turns to gold, it feels like. And now that's, I'm cautiously optimistic, right? But I am a huge fan of NVIDIA, of their culture, and the way that they are constantly looking behind their shoulder for their competitors. If you look at interviews with Jensen Huang, he'll say, we're always paranoid. It pays to be paranoid. And so that's NVIDIA's thing. And it's the same thing with Microsoft. It's the same thing with Apple, Google, Meta. All of these people have strong competitive advantages. They have economic moats. They have brand strength. They're household names that everybody knows. And they have super amazing track records of financial and operational success. That's what sets these companies apart. The second is financial strength. Actually, let's go back on something. Let's say that you're a bank and you want to give somebody a loan. Are you going to give somebody a loan if they have a terrible credit score and you don't think that they're going to pay you back? No? Yeah, well, me neither. When I put my money into a company, I want to ensure that they have the fundamentals that back up whatever my thesis for that company is. So what does that mean? That means, how much debt do they have? How much cash do they have? How much revenue are they bringing in? How long, if they needed to pay down all their debt, how long would it take to pay down that debt? So that's the component of financial strength. Is the company over leveraged? Because generally, companies don't really fail that easily unless they become over leveraged. So if you see a company and it has high debt to equity ratio, if it has high debt compared to the amount of revenue that it's bringing in, I don't like to touch it. I really don't. Some debt is fine. Debt is normal to have in a company. That's just part of the game. But if you have so much debt that in the next recession, when people stop, maybe you're producing goods that aren't always in demand, like toilet paper and toothpaste, maybe you have more luxury items, when people stop buying your product during that recession, what happens to your company, right? You want to make sure that you have the cash and reserves on hand to weather through the storm and get out on the other side. That's what I'm looking for. Number 3, and I think this is part of what sets me apart from a few other investors. Focus on high growth sectors. I'm sorry, I have absolutely no interest in 5% returns. That's what I can get in a bank account right now, practically, in a CD, right? Why am I going to put my money into a stock, into a company, if I'm only going to get 5% returns? So I want to look at industries that have a strong future demand and basically piggyback off of the expansion of that sector. Right now, it's February 2025, and the big industries with really strong tailwinds is artificial intelligence, cybersecurity, data centers and cloud computing. There's some fintech, digital payments. I'm not so big on that, but it is there. Semiconductors, high performance computing, and one that I'm really excited about but haven't invested in yet, robotics. I think robotics is a few years away, but I digress. So I'm looking for these companies that are positioned to lead in these sectors, dominate in these sectors, and come out as a winner in these sectors. I'm not just looking for this small, tiny company that might make a few bucks. No, I want dominance. My money will help these companies dominate. That's what I'm hoping for when I invest. The fourth thing is a long-term perspective. I want to make sure that these companies and their leadership have a long-term perspective on what they're doing. How far in the future are these companies looking? Are they reinvesting their excess cash flows back into the business, researching and developing the next frontier technologies, the next frontier services that are going to help expand the business. Companies can't stay stagnant, especially technology companies. It's very rare that a technology company stays static for a decade and doesn't die in the process. As a technology company, you have to stay agile and you have to always look 5 steps ahead to ensure that your company is not going to become obsolete and be cast by the wayside. That's why we need a long-term perspective in the leadership of these companies. Talking about management teams, management matters. Management matters. Warren Buffett has talked about this time and time again. It's very rare for people to invest in companies if they don't believe in the people who are running the companies. Look up your favorite CEOs. Think about them. Maybe it's Elon Musk. Maybe it's Mark Zuckerberg. Maybe it's Jensen Huang. All of these people are amazing leaders. They hold their employees to super high standards and they produce results. Those people have extremely consistent, high-performing track records. That's why I invest in their companies. Tim Cook, Steve Jobs back in the day, although I wasn't invested back then, but I would have, theoretically. All of these people are amazing. And it's like, if you received an application with Tim Cook's name on it, you would accept Tim Cook, right? And so that's what I mean. Number 6, and this is very, very important. No matter how good the company is, the price of the company, the price of the stock, the valuation of it matters. It matters. If Apple were valued at $30 trillion today, I would not touch that thing with a 30-foot pole. I don't care how reliable the company is. I don't care how great the management team is. You can't buy a company and expect to get a return if it's 30 times its fair value. It just doesn't make sense. And now, the thing is, valuation is a very hard thing. It's very difficult to value companies, especially that are growing at such a high rate, and they're technology companies. Growth stocks are very, very hard to evaluate. And so sometimes when you look at them, they might not always make sense, but it turns out that they were pretty cheap. For example, 1 or 2 years ago, NVIDIA had a PE of over 100. Today, I think NVIDIA's PE is around a 50. I think it's 50, 55, 60, something around there. Turns out 100 PE was pretty cheap. Now, not everybody knew that at the time, but that's my point. Valuation is hard, and it's hard to know when a company is overvalued, when it's undervalued, and that's difficult, and that's something that you have to learn as an investor over time. You have to get comfortable valuing your own companies, and you also have to get comfortable with just stepping away when you don't know how to value one. It's okay stepping away, but nonetheless, the valuation of a company still matters. When you look at these companies, because they are dominant market players, they all have pricing power over the goods and services that they're providing to their customers. If they can control their pricing, if they can raise prices consistently over years' time, and they don't lose customers, that company has pricing power. And that company is able to expand its margins, increase its revenue, and increase its net income over time, and that's going to earn you money. So that's why you buy the dominant market players, the ones that have these, nice segue, monopolies, legal monopolies, right? Going straight into number 8, talking about monopoly status, we want the companies that are dominant. We want the winners. We don't want the losers. Who wants to invest in a loser? I don't want to invest in a loser. Your ex-boyfriend, loser. Don't invest in him. Don't invest. He's on the couch. What is he doing? Probably good for nothing, right? No, we're going to put our money into the jock, future NFL quarterback who might be the 6th-round draft pick, but will win 7 Super Bowls, 6 with the Patriots, one with the Buccaneers, and will go down as a Hall of Famer, right? The greatest of all time, Tom Brady. That's who we're putting our money into. We want the Tom Bradys of companies. That's what we're looking for. Now, you'll notice something different about the format of this slide. It's not split in 2. That's because I think that these are the 2 most important characteristics of companies when I buy them. Okay? I think a lot of value investors get caught up in the desire to have a stock that is completely predictable. It just goes up and to the right forever, and that's all they want. Up and to the right, that's all I care about. But here's the thing. When you have a very predictable company that grows and grows and grows at the same rate over time, here's your 10%, here's your 10%, here's your 10%, those companies have a premium valuation on them. People buy those companies more. They're attracted to those companies more because there's safety in them. It feels like it's a safety net. It's like buying Berkshire Hathaway. Everybody has faith in Warren Buffett and the investments that he makes. So there's a bit of a premium to that. However, on the other hand, if you're buying a company that has uncertainty in its future, most people don't like uncertainty. If you like uncertainty, there's probably something a little bit twisted about you and your personality, right? And so that uncertainty leads to slightly lower prices in the stock. And so I think you should take advantage of uncertainty, but not so, you shouldn't have so much uncertainty in your position that it's speculative. You want a healthy amount of uncertainty where it's somewhere in the middle of completely safe and completely wacko, loony, crazy. Why would you ever put your money in this? I'm now down 70%. Oh my gosh, how am I ever going to recoup my money? Somewhere in the middle of there, that's the beauty. It's okay to be invested in cyclicals. I'm invested in chip makers. You know, you have to have a strong stomach if you're going to invest in uncertain companies, but the upside to those companies is so high, asymmetrical upside. The asymmetrical upside will make you a ton of money if you're right. If you're right. Another way of saying uncertainty is risk. High risk, high reward. Low risk, low reward. And that's basically how I'm going to sum up that point. Number 10, and I would say this is a very big one. The companies that you buy into, the capital that they have, should be allocated toward benefiting shareholders. If your companies that you're bought into are just constantly providing stock-based compensation to their higher management, to their executives, and they're doing absolutely nothing for the shareholders, that company is robbing you. The companies that you're bought into should be putting their cash back into share buybacks, into dividends, and into acquisitions that will help grow and expand their businesses. If they're not doing that and they're just, here executives, get more money, have fun with your new yacht. Yeah, man, well, I want a yacht too. Okay, so please buy back the shares. Please give me a dividend. Add to your company, get some acquisitions. Get me a yacht, man. I'm taking the risk, right? That's my take. So I think these are some really great characteristics to have in your companies. Let's move on. Aside from the stocks and the companies themselves, the portfolio needs to have certain characteristics in order to have high growth potential. Now, I told you that I would talk about my 50% concentration in NVIDIA. I know that's a little crazy. I am very aware that I've got a few screws loose. I know that I am subjecting myself to a lot of risk when I do that. However, diversification is the enemy of gains. Diversification, on the other hand, is also an antidote to stupidity. If you want a safe portfolio, go invest in the S&P 500. Go and find, this is not investment advice, go and find safe companies that are way less risky, create a portfolio of 100 companies, whatever you want to do. Go and do something else. My investment philosophy is what has worked for me, and I enjoy it. It's fun, it's nail-biting, it has its ups and downs. There are days where, you start to doubt yourself a little bit, but nope, I'm disciplined, I'm holding on for dear life, and I'm enjoying every second of it. And it's fun, it's enjoyable for me. So, listen, if this stuff isn't for you, it's not for you, man. But I've had pretty good returns in the stock market, and this is what's worked for me. I'm just trying to communicate that to you. Here's what I do. You need to have concentration in your high conviction holdings. So you need to focus on a very select number of companies that you really, really believe in. You've researched these companies, you know their businesses in and out, you know what they sell, you know their products, you know how they're developing their products, you know the research that they're putting in. You're comfortable with these companies. It's almost like you work for the dang company. And so when you buy into these companies, why would you not take bets on them? Why would I put $100 into a company and say, maybe it'll be fun? And that $100 returns, let's say it quadruples, right? Okay, now it's $400. That's not a life-changing amount of money. We want, with our portfolio, to give the companies that we invest in the potential to change our lives and build us into wealthier individuals. That's why we invest. We're not investing to dilly-dally and dip our toes in the dang pool, okay? We want concentration. Now, that doesn't mean put all your eggs in one basket. I had 9 companies and 1 ETF that I'm invested in, right? And so I'm not a proponent of just putting all your eggs in NVIDIA or CrowdStrike or whatever it is, but I am definitely not a fan of having 50, 100, 200 or more companies in your portfolio. I think it's a waste of your time. You're going to underperform the market. If you're going to do something like that and you want safety, go to the S&P 500. There's no shame in it. You might do better than me over the long run. Who knows? The second thing, sector diversification. In your high concentration portfolio, there needs to be at least some level of diversification. You can choose what's appropriate for you. Obviously, I am extremely concentrated in one sector, which is AI and or chip making, but you shouldn't have all your eggs neatly stacked just in one sector of the market, not all in AI. This fourth one, alignment with megatrends. You want to be, and this is sort of what I said earlier, right? Where you want to be investing in the companies that are investing in products where the demand is growing rapidly. And this is exactly the same. Your portfolio should be invested in sectors that are poised for this long-term expansion and growth over a long period of time, that's sustainable, organic, and where maybe there's a little bit of uncertainty. You know, nobody knows where AI is going to go, and that's the uncertainty about it, right? And that's what makes you money. If there's no uncertainty, there's no money involved. The last thing, your portfolio should be set and forget. When you do your research, what's that saying? If I had 6 hours to cut down a tree, I'd use the first 5 to sharpen the axe. Use your first 5 hours to research your companies, right? You should be doing a lot more research than that. But use your time wisely and invest your time first into researching the companies. And then once you've made your decision, set the money in there and just forget about it, man. You can follow the day-to-day. That's fine. I do it all the time. I love it. It's fun. It's great. I love seeing how my investments perform. But the day-to-day, you can't let the noise of the stock market. Maybe they have a bad earnings call. Last month, DeepSeek happened. NVIDIA dropped 18%. Do you think I was nervous? A little bit. But the forget part of set and forget is forget the noise. Just stop thinking with nervousness and fear and think about all of the research and work you put in that led to you investing in the company in the first place. Have faith in yourself and understand and have trust in the decisions that you're making to better your future and hopefully benefit your family. Maybe if you're going to be rich, you're going to donate to charity. Whatever reasons you have to invest and make these decisions, have faith in them. Have faith in your conviction. Investor temperament is essential. Oh my goodness. If you're just getting into looking at stocks, I mean, you gotta have a strong gut, man. I mean, there will be a day, there will be weeks, there will be months where you are down 30%. When I first bought into NVIDIA, I think I said, it was 2021, right? Well, 2022, my investment was down 66%. It was down 66%. I had a buddy buy into NVIDIA at the same time as me. It dropped 66%. He came up to me. It was our senior year of college. He came up to me. He said, Alex, NVIDIA's just really not doing it for me. I sold my shares. And I said, I understand, man, but I don't agree with you. So he sold, I didn't, and you can type in NVIDIA stock into Google, you can see where it's at now. So I have no regrets. Now, I'm giving that guy a hard time. He's one of my best friends, but if he had a little bit of better investor temperament, he would have maybe done a little bit better. So the first thing is discipline. You have to adhere to your investment strategy no matter what. You can't let emotions and random news stories coming in affect how you invest. It has to be by the book, what you've decided for yourself. If you don't like my way of investing, create your own, man. Go make your own freaking presentation. Have fun with it. Enjoy it. It's a great process. But you have to have discipline and stick to your guns. The second is patience. You're not going to have 10x returns overnight. It's not going to happen. Investing is a slow, drawn-out game that happens over decades. It is not going to all happen overnight. The third is emotional intelligence. When people are coming up to you, when you're getting Instagram reels where the market's selling off, oh my gosh, DeepSeek and all this stuff, dude, you have to trudge through the fire. Everything's on fire around you, and you just have to be okay with that. That's emotional intelligence. It's understanding how you're affected by others. It's understanding what you need to do to keep yourself calm and to not make irrational decisions, no matter the circumstances that you're in. No matter what, logic reigns king in the investment world. Panic selling is what is going to kill you. It kills a lot of retail investors. Stay away from it. Last is self-awareness. There are things that you understand. There are things that you don't understand. For example, right now I'm in school to become an astronautical engineer. I know a little bit about rockets. I know a little bit about engineering. I know a little bit about math, whatever, right? You know what I don't know about? I don't know a lot about banking, to be honest. I know a little bit. Okay, they give out loans, they get some interest back. That's how banking works. It's not my forte, though. It's not what's important to me. I don't know anything about it. So be aware of the stuff that you know about and look at the companies that match what you know about. Warren Buffett coined the term circle of competence. That's a beautiful term. You should write it down. It's great. Invest in the companies that are in your circle of competence. If you look up a company and you just don't understand it, I was watching I love this YouTuber, Joseph Carlson. I was watching a Joseph Carlson video today, and he was talking about GE Aerospace. And he said, you know what? Chris Hone, who's a hedge fund manager for TCI, he's been invested in GE Aerospace. You know what Joseph Carlson says? He says, honestly, I don't know anything about GE Aerospace or why it's going up. I don't understand the company. I'm not touching that thing. And that is exactly what you should do. If you see a company and it's going up and to the right and you don't understand what's going on, don't touch that thing. You want to be able to understand exactly what is going on behind the scenes at the company. What are their products doing? Why do people buy the product? Why is the company going to go up and to the right? Why has it been going up and to the right? Why do you see a future with your money? It's a relationship, right? Why do you see a relationship between you and this company in the future? The last thing, live in truth, man. Do not allow I'm going to read this verbatim. I think I put it really well. Do not allow the market's reaction to news or developments influence your own reaction. Panic selling and following the herd is all too common, especially in retail investors. Understand why the market is having the reaction and independently determine whether you agree or not. Do not delude yourself into believing that a poor investment decision is a good one. Cut your losses and move on to better companies. I was talking to a buddy. You know who you are. I'll see you at lunch, man. But I was talking to a buddy, and he was telling me how he invested in this random uranium ETF, and this random uranium ETF was down 30 or 40%, and he said, but it's going to go back up eventually, right? It's going to go back up eventually. And I asked him a question about the uranium ETF. Why are you invested in the uranium ETF? Oh, I just kind of bought it for jokes. Just cuz. I bought it just cuz. Yeah, man, cut your losses. Put your money into a better investment that you actually understand. Do not delude yourself into thinking that you are an expert on everything. Understand your limitations. Make good financial decisions with your money. Your retirement, your family depend on it. Everybody knows how to buy a good company. Nobody knows when to sell their good companies. And for me, it's very simple. There are only two situations when you should sell a company. When your investment thesis on the company breaks down, it is no more. When the things that you once assumed and thought you knew about the company are no longer in play, you should probably sell that company. So if it turns for the worst, if your investment thesis was on thin ice, you finally broke through, you're in the frozen lake and you're just shivering and about to get hypothermia, man, sell out of that thing. There are other fish in the sea. There's a lot of stocks out there. Second situation is when there are better investment opportunities that exist. Now, I learned this probably I think it was freshman year of high school. Opportunity cost. And I'll give you an example of this. Slowly but surely, I've been selling out of my Apple position. And it's not because Apple's a bad company. It's not because it's a bad investment necessarily. I mean, they're growing at 5% maybe per year, and that's pretty good. And then they're doing share buybacks, so that probably adds up to maybe 8 or 9% per year, which is pretty good. That's pretty good. That's about market average. And so why would I sell out of that? Well, because I'd rather have 15 to 20 or 30 or God knows how high it can go, percent growth versus 8%, 9%. And so when there's a better investment opportunity that exists, allocate that capital toward the better investment opportunity, pay your taxes on your gains, whatever, and then move on with your life. And that's when you sell stock. And just like I said about opportunity cost, in my opinion, if it's not over 15%, it's really not worth my time. If you're looking for a heavy hitter growth stock portfolio, don't be afraid of it, man. Look for the things that you genuinely believe are going to return over 15%. Otherwise, I don't see why you're spending so much time and having headaches over this stuff and researching online and listening to news conferences and quarterly earnings calls. Why are you putting in all of these hours of work to build a thesis on a company that's going to get you 3% a year? There's just no point. There's no point. And so if it's not over 15%, it's not worth my time. Now, I've gone over a lot of things related to what me as a 24-year-old dude does for his own portfolio. I would encourage young people to take risks because you're going to have an income, right? Assuming that you're a normal person. You're going to go out there, you're going to get a job, you're going to have an income, and you can recover from whatever dumb financial losses that you take on when you're 18, 19, 20, right? That's fine. But if you're older and you're looking toward retirement and say you're about, I would say maybe 45 is usually when I see people start winding down for retirement. You know, there has to be a difference in your risk allocation and your risk tolerance. And so that doesn't mean you have to sell out of all your growth stocks, but I would really encourage you to take into account how old you are and have that help determine how much risk you're taking with your portfolio. It's easy for a 24-year-old dude with job security to tell people, hey, go out there and take some risks. Of course, that's easier for me to say, but it's not suitable for everybody. So, consult with a financial advisor, do your own research, and make sure that whatever you do with your own portfolio is truly within your own best interest. And that's all I have for this video. I hope you guys took something away from my last 6 years of experience in the stock market and all the things that I've learned. If you guys have any questions or comments or concerns, feel free to leave them in the comments. And if I've earned it, feel free to subscribe. Thank you all so much. Have a good one.